Forget everything you know about current tokenomics best practices, which rely on a time-based vesting schedule for token allocations. They lead to a massive pump and dump cycle that kills token economies. In this video, I will describe how Web3 entrepreneurs can launch a financially sustainable cryptocurrency based on a novel price-based vesting strategy that focuses on treasury management supported by a dedicated market-making strategy. But first, why are current tokenomics practices obsolete? Except for stablecoins, cryptocurrencies have demonstrated their inability to avoid massive volatility with pump and dump cycles of 4 years or less that leaves countless community members in ruins while favoring greedy market makers and market manipulators. Unlike equity of private companies where investors are locked in for 5 to 10 years, investors of token economies typically get to an exit much sooner, often even before the project has reached a product-market fit. For this reason, Web3 ventures shouldn't fund themselves from token sales. I recommend a pre-launch strategy that relies on the staking of mature crypto assets such as Bitcoin to build an external treasury that can sustain the business without having to sell native project tokens prior to being truly ready. Additionally, in the absence of a significant revenue stream, tokenomics alone cannot sustain the economy, as it will reach a point where the release of tokens on the market from a short vesting schedule will collapse the token price. There's a better way using price-based vesting. Unlike time-based vesting, which often releases tokens at the wrong time when market adoption is weak and leads to price capitulation, a price-based vesting schedule implies that new token releases are not distributed in the market unless buying volume is greater than selling pressure. When tokens are released in circulation when price is going up, it can slow down price growth without leading to price decrease and capitulation. Let's look at an example of a tokenomic model with price-based vesting. Here we have multiple token allocation pools such as team, market making, staking, community, and operations that get unlocked based on price. For this, we run a liquidity pool on a DEX, and in parallel, we run a market-making order book system that controls the release of these token pools, but only if market adoption pushes the price up to trigger a limit sell order. Only then the tokens are released onto the market. Otherwise, if market adoption is equal to the selling pressure or worse, then the limit sell is not triggered and the tokens are not released. This means the only way for these tokens to become part of the circulating supply, the buying pressure has to be greater than the selling pressure for the price to push through one of these resistance zones. The resistance zone is essentially where the limit sell is placed to reduce the speed of growth without actively pushing the price down. It's acting only as a speed bump. Since the mathematics of a bounding curve, which dictate how price moves on a DEX, lead to a 4x price increase if liquidity is doubled, it means price is increasing too rapidly than the actual liquidity and often lead to pump and dump cycle. In this case, the release curve based on price is adjusted to absorb 50% of the buying volume, meaning that price increases only 2x when liquidity increases 2x. With that said, since the market-making pool absorbs a significant portion of the excess buying volume instead of going into the liquidity pool, then we end up with an external treasury that can then be used to buy back tokens if the price goes back down. This will stabilize the price from crashing excessively while also reducing the speed of growth to an acceptable level. Relying on an external treasury with this market-making strategy means if the market is mostly going sideways in regards to price, then the treasury keeps increasing and could potentially even reach a point where the token economy is over-collateralized compared to the market cap in circulation. However, instead of preventing token price to grow like a stablecoins, this model allows for token price to increase just more slowly than usual while collecting an external treasury. The excess treasury can be allocated to various DeFi instruments to generate additional yield. And just like Tether, this could represent a massive revenue stream independent of a product market fit. Tether generated $5 billion of profit in first half of the year because of a very large treasury under management, and they didn't have to allocate tokens to the team or investors to serve as upside since they have significant revenue generated every day. With these market-making and treasury management activities, Web3 ventures could expect a few $1 million of revenue per year if they have a token with a fully diluted market cap of $50 million or more. If market adoption is very strong, it is possible that all tokens will be released in the market much sooner than a time-based vesting schedule would allow, but it could also be much longer. In the previous scenario, all tokens will be in circulation by the time the price reaches $10, which is equivalent to a fully diluted market cap of $1 billion. The main difference compared to most crypto projects is that if a token that uses this model reaches $1 billion of market cap, There would be a treasury of several $100 million that can be used to generate revenue, but also absorb potential selling pressure when the time is needed, regardless if the project has real users for the utility they are building. In summary, this approach means the market-making strategy that runs in parallel to the DEX liquidity pool will provide additional support and resistance in the price structure, but will not actively move the price up or down. The same can be said for a CEX listing with some minor tweaks. The most important is to understand that this tokenomics and market-making model is optimized to ensure tokens are not released on the market when selling pressure is already greater than the demand, which leads to price collapse. If a token price grows at 1,000% instead of 2,000%, it is not the end of the world. But if the token price crashes only 25% instead of 50%, that may be enough to prevent panic selling and price capitulation that too many projects never recover from. This strategy has been designed by Smooth Labs LLC, a company that operates various technologies to support financially sustainable token launch, including market making, treasury management, staking pad, and launchpad.